Now let's move on to bank lending. We are going to divide our discussion into three parts. First, we are going to discuss loans. Second, we will run through the types of customers that banks deal with on the lending side. And third, we will talk about the actual mechanics of bank lending. We will describe how a loan comes into existence. Formally, what is a loan? Well, it's a financial instrument. It is debt. When I borrow from a bank, I am entering into a legally binding commitment to repay according to some predetermined contractual terms. There will be an interest rate. This rate may be variable or it may be fixed. The loan may be secured by some collateral. There might be performance-related clauses written into the contract. These are called covenants. Senior debt gets the first priority on business assets in the case of bankruptcy. Banks usually break their lending business down into two categories: consumer credit and commercial lending. Consumer credit includes loans backed by residential real estate. This includes mortgages and home equity loans. We also have credit cards, auto loans, and student loans. Commercial and industrial lending includes loans to businesses. These can be commercial real estate loans, term loans, which include long-term lending for investment, or business lines of credit, which act a lot like credit cards for businesses and can be used for working capital. Let's take a look at the customer base of commercial banks. Who do banks lend to? Larger businesses tend to bypass commercial banks and borrow directly from financial markets. They issue bonds and raise equity finance. There is lots of public information about these firms, and information costs are small. Sometimes the larger firms will use commercial banks to arrange loans when they are in a special situation. This could be a takeover transaction or a troubled debt restructuring. Middle market lending is the bread and butter of the commercial banking business. This is sometimes called relationship lending. These are medium-sized firms with limited public information. They are probably not listed on a public stock exchange, and investors might be worried about adverse selection. Finding new business customers, performing credit analyses, funding new loans, and maintaining relationships, this is the central role of loan officers and credit committees at most banks. Small and new businesses typically do not have access to bank credit without some form of guarantee. These can be personal guarantees of the business owner. The Small Business Administration may partially guarantee these loans. The business owner might pledge his personal assets as collateral: houses, boats, other financial wealth. Small businesses are risky and often fail. Guarantees and collateral help reduce the risk and bring banks on board. Among loans to individuals, mortgage credit is the core focus of community and regional banks. These loans are also information sensitive and can depend on the individual circumstances of the borrower. Credit cards, student loans, and auto loans, these tend to be small and costly to make on a per-loan basis. There are large economies of scale in this market, and so larger banks and non-banks that can create big, diversified pools of these loans tend to dominate this space. We can see where these different customers show up across JP Morgan Chase's business segments. Their consumer and community banking arm is what I have been calling retail banking. Consumer and business banking means deposit taking and providing consumer credit and small business loans through the branch network. Home lending covers residential mortgages and home equity loans. The card and auto segment takes care of credit cards and auto loans and leases. This is all for individuals and small businesses. Commercial banking sits within the wholesale banking business. Commercial real estate includes financing for office space, property development, industrial space, and so on. For business banking, JP Morgan separates out its clients into two groups: middle market and corporate client. According to their investor reports, middle market banking covers small and mid-sized companies with annual revenues between $200 and $500 million. Smaller than this means you're in the community banking bucket. Corporate client banking covers large corporations with annual revenues between $500 and $2 billion. Bigger than this means that the investment banking arm will take care of you. And so we can map JP Morgan's business model onto our diagram from before. Here is the wholesale business. It covers lending to middle market firms. And here is the retail business. It covers lending to small businesses and individuals. Okay, that's an overview of the commercial bank business model. Banks raise funds from a variety of sources and grant a broad array of loans.